For over a decade, money was basically free. You could borrow cheaply. Startups raised millions with just an idea. Real estate prices exploded. Crypto went vertical. Stock markets broke records again and again. And most people thought this was normal. But it wasn't normal. It was artificial. And now? The era of cheap money is over. In 2026 will separate people into two groups, winners and victims of the new cycle. This isn't fear content. This isn't financial advice. This is understanding the shift. Because the biggest wealth transfers in history happen during transitions. And we are in one right now. After the 2008 financial crisis, central banks around the world cut interest rates close to zero. Why? To stimulate growth. Cheap loans. Cheap mortgages. Cheap business financing. Then came more stimulus during global crises. Governments injected liquidity. Markets were flooded with capital. When money is cheap, investors take more risk, asset prices go up, growth is prioritized over profit. Debt feels harmless. If you started a company between 2012 and 2021, you lived in an abnormal environment. Growth mattered more than profit. You could lose money for years and still get funding. Real estate? Prices went up because borrowing was cheap. Crypto? Speculation exploded because liquidity was everywhere. The system rewarded leverage. And most people thought they were financial geniuses. But here's the truth. When money is cheap, everyone looks smart. Inflation. When too much money chases limited goods, prices rise. Central banks had to react. Interest rates increased aggressively. Suddenly, mortgages doubled, business loans became expensive, venture capital slowed, risk appetite collapsed, debt that was once cheap became dangerous. And here's where psychology shifts. In a cheap money world, optimism dominates. In an expensive money world, discipline dominates. We are transitioning from optimism to discipline. And most people are not mentally prepared. Interest rates are the price of money. When that price increases, everything becomes more selective. Let's break it down. Real estate: higher mortgage rates equals fewer buyers. Fewer buyers equals slower price growth or corrections. Developers struggle. Flippers disappear. Speculative demand declines. Startups: investors demand profit. Growth at all costs dies. Burn rate becomes a red flag. Only sustainable models survive. Consumers' credit card interest increases. Car loans increase. Personal debt becomes heavy. People reduce spending. And when consumers slow down, businesses feel it. This is how cycles tighten. Let's be honest. Not everyone will win. 1. Over-leveraged individuals: if your lifestyle depends on debt, you are vulnerable. 2. Businesses without profit: companies that rely on constant funding struggle first. No profit. High debt. Weak cash flow. Dangerous combination. 3. Speculators: quick flips become rare. Easy gains disappear. The new environment punishes impatience. 4. People who ignore cycles: economic cycles are real. Boom. Slowdown. Adjustment. Recovery. Ignoring this doesn't stop it. Now the interesting part. Every cycle creates opportunity. 1. Cash flow businesses. Boring, stable, predictable. When capital is expensive, stability becomes premium. 2. Low debt companies: strong balance sheets matter again. Financial discipline becomes competitive advantage. 3. Investors with liquidity: cash becomes power. During corrections, assets go on discount. Those with reserves buy. Those without watch. 4. Skilled individuals: in uncertain economies, adaptability wins. High-value skills. Financial awareness. Strategic thinking. 2026 rewards competence. This is where most people fail. They react emotionally. Fear leads to paralysis. Greed leads to risk at the wrong time. Smart players study cycles. They don't panic. They reposition. Understand this. Cheap money rewarded expansion. Expensive money rewards efficiency. That shift changes everything. Maybe not dramatic. But slower growth is already visible. Bankruptcies increase in tightening cycles. Hiring slows. Margins compress. This is not collapse. It's recalibration. The problem? Many businesses were built on unrealistic assumptions. And assumptions get tested in tighter environments. If you're an entrepreneur, audit your expenses, reduce unnecessary debt, focus on profitability, strengthen cash reserves if you're employed, upgrade your skills, increase financial literacy, build emergency savings if you're investing. Be selective, avoid over-leverage, think long-term. This is not about fear. It's about positioning. Here's what nobody talks about. Tight money environments eliminate weak competition. When others quit, markets open. When others panic, opportunities appear. Some of the biggest fortunes in history were built during transitions. Because assets become undervalued. And discipline compounds. Rule number 1. Cash flow greater than hype. Rule number 2. Profit greater than growth. Rule number 3. Liquidity equals leverage. Rule number 4. Discipline beats optimism. The new economy is less emotional. More calculated. More selective. More realistic. Every economic cycle creates two types of people. Those who panic. And those who prepare. The era of cheap money trained people to chase growth. The next era will reward resilience. You don't need to predict everything. You need to adapt. Because 2026 won't be about who was lucky in the boom. It will be about who survives and compounds in discipline. The question is simple. Will you adjust to the new cycle? Or will you pretend nothing changed? If this video helped you understand what's happening, like the video, comment your thoughts, and subscribe for deep breakdowns of money, power, and strategy. Because understanding cycles is understanding wealth.